Many investors treasure dividend-paying stocks for their ability to provide passive, reliable income and support portfolio growth. But did you know that there's a special group not like the rest, called Dividend Aristocrats? Consider these the golden retrievers of the stock market, thanks to their proven and reliable payouts. For any dividend, long-term payout increases tend to indicate a financially stable company, which can help investors feel confident in where they've parked their money. Well, when it comes to Dividend Aristocrats, they're basically the crown jewels of dividend stocks, and it's for these three reasons. 1. The company issuing the stock must have raised their dividend for at least 25 consecutive years. 2. These are exclusively American S&P 500 companies, which means they're well-established businesses with historically strong and stable incomes. And 3. The company issuing the stock must have a minimum market capitalization of $3 billion and have had at least $5 million worth of shares traded daily over the past 3 months. So, how have they historically performed? Dividend Aristocrat stocks have consistently offered a higher dividend yield than the S&P 500 over the past decade. However, yield isn't the only factor to consider. Growth stocks could deliver better total returns over some periods due to appreciation in their stock prices. It's important for Canadians to note that Dividend Aristocrats are U.S. stocks. Therefore, a foreign tax could apply to them in most investing accounts besides RRSPs. But luckily for us, we have Canadian Dividend Aristocrats. And when we hold these in registered accounts, we can gain tax-sheltered or deferred growth. The criteria that makes a Canadian Dividend Aristocrat is slightly different than their American counterparts. For example, they must have increased their dividend for at least 5 consecutive years, not 25. They must have a minimum market cap of $300 million versus $3 billion. And they must be listed on the Toronto Stock Exchange. If you're investing in individual dividend-paying stocks, it's important to know a couple key dates for receiving dividends. The stock's payment date, which is when you can expect to receive the dividend payment into your account, and the ex-dividend date, which is the date that the stock price begins trading without the dividend factored into its price. So, if you buy shares on or after ex-dividend date, you won't be eligible for the associated dividend payment. Whether you're buying Canadian or American, Dividend Aristocrats can come with a higher price tag since they're being issued by large established companies. But this is a barrier you can overcome by buying them in partial shares. Another option is that you can invest in mutual funds or ETFs, which contain Dividend Aristocrats. Finally, before investing in dividend stocks, remember that dividends are just one component of your investment's growth. Keep an eye on the stock price, as potential declines impact your overall return. While dividend stocks tend to be more stable, growth stocks that don't pay dividends may outperform them during certain periods. Additionally, dividend stocks typically aren't high-growth investments because they may not have significant opportunities to reinvest their cash flows, hence why they often pay out dividends. This focus on paying out dividends could potentially affect a company's long-term performance. Once you're ready to research dividend-paying stocks, head over to WebBroker and check out the Screeners tool. Start with the preset screener for top dividends, and then you can customize it by stock price performance, market capitalization, and more. If you want to learn more about dividends, check out our video 3 Ways to Build Wealth with Dividend Investing on YouTube and in the Learning Center.